The number one economy in the world is currently in a recession, and despite how hard the US government denies this, it is apparent that the US is experiencing a recession. The US economy has contracted for the past 2 quarters, and it is expected that it will continue to contract in this year's 3rd quarter. However, what exactly led to all this? How long will this recession last? Could this be as bad as the 2008 housing crisis? Stick around as we find out. Thanks for supporting our channel. Let's dive right into the video. According to Cathie, a well-known American investor, the United States of America is currently in the midst of a recession. The White House, on the other hand, is not in agreement, and President Biden has stated that the US seems unlikely to be in a recession. It would appear that politicians are willing to redefine anything in order to further their own goals. They will try to convince you that inflation is not nearly as bad as it actually is. The rate of inflation is at an all-time high. How in the world are they able to say that inflation is not that bad when consumers across the US are suffering from high prices? The Federal Reserve has recognized the issue and begun to raise interest rates in an effort to remedy the situation. When the economy experiences a recession, businesses and production slow down temporarily. Typically, this is indicated by GDP dropping for 2 consecutive quarters. Therefore, we are in a recession if the gross domestic product falls for 2 consecutive quarters, as this is the minimum threshold for entering into a recession. When a recession goes on for longer than 2 years, it is considered a depression. When Trump was the president of the United States and the COVID pandemic was at its height, his opponents attacked and said that he lied about everything regarding COVID. As a result of his poor management of COVID, the economy entered a period of contraction. Fast forward to now, Democrats are also screwing up the situation. They are actually redefining the meaning of the term recession in order to avoid taking accountability for their shortcomings. When the results of the 3rd quarter finally come out, which will happen very soon, we shouldn't be astonished if they show a decline once again. Since the Fed will probably continue raising interest rates in response to excessively high inflation, home loan payments will undoubtedly continue to rise. Prices of homes have already begun to fall since there is less demand for them. Nonetheless, construction firms are ramping up their home building efforts. It's true that home sales are on the rise again, but they're not growing nearly as quickly as they were over the past 2 years. The cost of housing is actually going down in many different states. The power dynamic has shifted away from the seller, who formerly had the ability to dictate terms and extract higher prices. The average price of a home increased from $322,000 to $440,000 between the time COVID-19 broke out and today. Even before the crisis of 2008, prices didn't increase significantly, which has prompted many economists to worry that we may be on the verge of another housing crisis. Will the housing market eventually tank? Is it likely that the crash will be as severe as the one in 2008? All sectors of the economy are interconnected. Therefore, problems in one area will have repercussions elsewhere. Consider any one of the recent financial crises. It had a domino effect on the economy as a whole, rather than just fields related to the root of the crisis. An excellent illustration of this is the housing bubble that occurred in 2008. It caused suffering all around the world. The S&P 500 lost over half its value between January 2008 and February 2009. The collapse of the property market in the United States was a contributing factor to the debt crisis in Europe, which in turn brought down one economy after another in that region. Greece and other nations continue to experience the effects of the crisis. Drops of over 50% were seen even in Apple, which was not at all associated with the situation. The market was decimated, wiping out trillions of dollars. Therefore, the state of the economy as a whole should be taken into account in order to predict the future of the housing market. Following the bursting of the dot-com bubble and the subsequent collapse of the stock market, the Federal Reserve brought interest rates down to 1.5% by 2002 in order to encourage economic expansion. The housing market collapse started around that time. All those eligible for mortgages applied for them during the period of cheap interest rates, which caused prices to soar sharply. Within the span of just 2 years, there was a 15% increase in price. The Federal Reserve then concluded it needed to boost interest rates to prevent a collapse in the housing market. Unfortunately, by that time, it had already blown up into a bubble and was heading for a collapse. The Federal Reserve hiked interest rates from 1% to over 2% between July and December of 2004. Rates reached a new high of 3.25% in July 2005. The increase occurred over the course of the following year until it got to 5.25%. After that point, the market began its downward spiral, which culminated in a complete collapse by the close of 2006. Let's evaluate how that stacks up against current market conditions. In the 2 years between the second quarters of 2020 and 2022, home prices rose by more than 35% on average. To put that in perspective, the rise in home prices during the last housing crisis was half that amount. In order to put a stop to inflation, the Federal Reserve is increasing interest rates, which will have an effect on the housing market. Nonetheless, home prices continue to rise. Even if the Fed manages to suppress demand, it will likely be some time before house prices level out. The Federal Reserve has increased interest rates from 0.25% since the start of 2022, bringing them up to a current level of 3.5%. In the following year, we might easily see interest rates above 5% if the current trend continues. Even if inflation were to settle between 2% and 3%, the Fed would be unable to immediately reduce interest rates. The availability of freshly built homes has already reached levels not seen since before the economic downturn of 2008. Although there haven't been as many new listings on the market recently, many homeowners are holding on because of the continued appreciation of their properties. Those who have already made the decision to sell are not obtaining the maximum return on their investment since demand is now falling. Even so, there is some continued price inflation. The current projections from the Federal National Mortgage Association indicate that the cost of buying a residence in the United States would increase by 10.8% in the year 2022. It's unclear how high they'll go, but even a slight increase would signify that prices have increased by more than 50% in just 3 years. Many economists claim that high demand is what drives up home prices. Nevertheless, high demand was another factor that contributed to the most recent financial catastrophe. There were undoubtedly more elements at play in all the financial crises, but it must be borne in mind that no two crises are alike. A crisis is never the same twice. Many distinct events can result in the formation of bubbles. The businesses who sold Michael Burry mortgage-backed assets in 2005 and 2006 believe him to be an idiot, since he speculated against the value of those assets by selling short. After Burry began shorting the market, it was over 2 years before the housing market finally crashed. This isn't something that happens instantly. In contrast to the stock markets, real estate values do not experience wild swings. Rather, they typically increase by a few percent to keep pace with inflation, or by a significant amount until they become overvalued and burst, only to begin falling again. Right now, it's challenging to make any specific projections. On the other hand, it appears that once the Fed raises interest rates high enough to destroy mortgage applicants, which is possibly by the end of the following year, we will begin to witness a decline in property prices. The cost of borrowing money has already skyrocketed. The average interest rate for a mortgage with a term of 30 years and a fixed rate has increased by 2% in a mere 4 months, making this the first time this has happened since the 1980s. The rate increased from 3.11% in December to 5.11%. The United States is now experiencing a recession, one in which the Federal Reserve cannot comfortably cut interest rates. Therefore, it would be overly optimistic to anticipate continued growth in housing demand. When it comes to the recession, nobody knows for sure how long it will stay. Given the complexities of the situation, such as the unknown outcome of the conflict between Russia and Ukraine, this is a question we just cannot answer. When will the Chinese real estate bubble pop? How will the European Union, the main economic partner of the United States, find a solution to its energy crisis? The Federal Reserve has gone to extraordinary lengths to combat the problem by printing unfathomable sums of US dollars in 2020 and 2021, which has resulted in the formation of a massive bubble. The consequences of the Fed's actions have arrived, and geopolitical threats are forcing the US to make decisions that will make matters worse. The current rate of inflation would be lower if Russia had not invaded Ukraine. This unprovoked war has led to a worldwide spike in the costs of both petroleum and food. What are your thoughts on this recession? Do you think it could turn into a full-on depression? Give us your insights in the comments section down below. If you enjoyed this video, give us a like and subscribe, and we'll catch you on the next one.